Thank you for joining us at xm.com for today's market comment by Marios Hadjikyriacos. I'm Maria Pachurdes. A surprisingly hot U.S. inflation report was not enough to frighten investors yesterday. Inflation, as measured by the Consumer Price Index, clocked in at 3.2% in February, missing expectations that it would remain steady at 3.1%. It was a similar story for core inflation, which slowed less than anticipated. Despite the overshoot in inflation, global markets did not react much. The dollar climbed as investors dialed back bets of a Fed rate cut in June, but its gains were limited. Investors appear confident that this inflation setback won't materially change the timeline of Fed cuts, as other U.S. data releases have been on the softer side lately, especially on the labor market. Overall, there's a clear asymmetry in how the dollar has reacted to economic data in recent months. Stronger data releases seem unable to boost the greenback much, whereas weaker indicators tend to inflict serious damage on the reserve currency. One element behind the dollar's inability to storm higher has been the sanguine tone in equity markets, which has suppressed demand for safe haven plays like the dollar. In other words, any sustained dollar rally might require a correction in high-flying stock markets, which does not seem imminent. Shares on Wall Street completely brushed aside the hot CPI readings and instead cruised higher to close at new record highs. Chip makers and heavyweight tech stocks led the charge, with Nvidia shares gaining a stunning 7% as the hype around artificial intelligence reached fever pitch. It was a deafening show of force, as equities seem immune even to their arch-nemesis, which is interest rates staying higher for longer because inflation is persistently hot. Stocks can absorb bad news on economic growth without much damage, as that would bring rate cuts closer, but they are usually more vulnerable to negative inflation news. Gold prices suffered their first retreat of this month in the aftermath of the hot CPI prints, as a spike higher in bond yields and the dollar diminished some of the precious metals' appeal, sparking a wave of profit-taking after an incredible rally. Meanwhile, the Japanese yen has struggled this week, even despite mounting signs that the spring wage negotiations were a huge success, opening the door for the Bank of Japan to tighten policy as early as next week. Thanks for watching today's market comment here at xm.com.